Candlesticks are a specialized technical analysis tool that compiles information for numerous time allotments into single price bars. This makes them more helpful and slightly more complex than customary open-high, low-close bars, OHLC, or straight lines that draw an obvious conclusion of closing prices. Candlesticks form patterns that anticipate price direction once finished and are appropriately color-coded to show it. Candlesticks date as far back as the 18th century, when Japanese rice traders used candlesticks to keep track of their commodity transactions. Breaking down a candlestick. Before we go into reading patterns, it's important to understand how to read a basic candlestick. A candlestick is made up of several parts that indicate different pieces of data. The following is a quick breakdown of the formation of a simple candlestick. Body, real body. This is the wide part of the candlestick, which shows us the price range between the open and close of time specified. For example, when you're setting up a chart and you choose a 1-minute candlestick, each completed candlestick in that chart is going to show the price fluctuations for each minute of trading. If you're using a colored candlestick chart, the body of the candlestick will change color based on the opening and closing of the price within the specified time. Some traders like the traditional hollow or filled candlestick chart, but they mean the same thing regardless if you're using colored or hollowed. A red or filled candlestick indicates that the closing price is less than or below the opening price. This shows us the sellers have won this candlestick. A green or hollowed candlestick body indicates that the close is above or greater than the open, which shows us the buyers have won this candlestick. Shadow or wick. At the top and bottom of a candlestick, you'll notice a line coming out of the body. These lines are often called a shadow, tail, or wick, and they show us the highest and lowest prices that were reached during the specified time. On red, filled-in candlestick. If the top wick is small, it shows us the opening price was near the high of the specific time frame. On green, hollowed candlestick. If the top wick is small, it shows us the closing price was near the close of the specific time frame. Bodies and wicks can be as long or as short as needed, and can represent anywhere between a 1-minute time period to days, months, or years. It's not uncommon for wicks to be longer than the body. Remember, the wicks represent the highest and lowest points the price has reached, while the body represents the opening and closing range of the price action. How reliable are candlestick patterns? Not all candlestick patterns work similarly when compared to each other. Their fame has grown and brought down their reliability since they've been deconstructed by hedge funds and their operational procedures. As such, hedge fund investment managers employ software to ensnare financial market participants searching for high odds, bullish or bearish results. In any case, reliable patterns keep on showing up, giving room for short and long-term profiting, especially when they form alongside action targets. Some candlestick patterns that are popular and perform well as indicators of price direction and momentum. All of these patterns are also time-bound in two different ways. In the first instance, they only work within the restriction of the chart being technically analyzed, regardless of whether the market is on an intraday, daily, weekly, or monthly time frame. In the second instance, the strength of these candlestick patterns usually plummets after about 3 to 5 candlestick price bars after the pattern has been formed. Doji candlestick patterns. A doji candle is the name given to patterns which signal indecisiveness in the price activity of a security. Generally, these are shaped at regions where the bulls and bears start fighting and are battling each other for market dominance. In a doji candle, the body is typically short, with the close very near the open price, and can have long wicks formed to the high and low. The pattern implies vulnerability, uncertainty, and is sitting tight for either the bulls or bears to take control. Usually, the next direction the market would go in is an upwards or downwards move in price as the price action breaks past the doji. Even though the doji candle is not a reliable entry candlestick by itself, because of its inclination, it could be broken whichever way by the bulls or bears. It offers a heads up that market might be changing hands. Hammer candlestick patterns. A hammer reversal candlestick pattern is shaped when support or resistance is rapidly dismissed by market participants, forcing the price to move lower but still discovered some support or purchasing volume away from the low initially reached. Patterns like this show that the bears attempted to dominate the market, but for some reason they weren't allowed full reins as the bulls took charge, closing the market at a price level very close to the original opening level. These sorts of patterns can occur in either an uptrending or downtrending market, and when it does, it has the tendency to behave like a hammer, knocking price in the direction, hence the name. Engulfing candlestick patterns. Bullish engulfing candlestick. A bullish engulfing candlestick pattern comes into existence when the price action moves past both the high and low of the earlier day's price range. It overwhelms the previous price range, which is how it gets its name. Generally, this kind of pattern will tell a trader the price has moved down, discovered some support or purchasing volume, and afterward made a bullish move back up by surpassing the earlier day's highs. Regularly, this kind of candlestick can be the flag for a maintained upward move or a change in the foregoing trend. This candlestick is indicative that the number of buyers in the market is greater when compared with the number of sellers, and it sends the signal that a reversal in the direction of the bullish engulfing candle is not likely, but rather a continuation of the current direction it is expected. Consequently, traders can ride this new trend wave and turn in a good profit. Bearish engulfing candlestick. This is the reverse of the bullish engulfing candlestick. A bearish engulfing candlestick pattern will move sharply downwards, breaking the previous day's lows after moving to a test level above the previous day's highs. This pattern precedes a sharp, sustained drop in the price of an underlying asset or a change in the dominant trend. This candlestick is indicative that the number of sellers in the market is greater when compared with the number of buyers, and it sends the signal that a reversal in the direction of the bearish engulfing candle is not likely, but rather a continuation is to be expected. Consequently, traders can ride this new trend wave and turn in a good profit. Best places to trade candlestick patterns. Trend reversals. Late in the trend, a candlestick pattern is a very short-term signal and so doesn't indicate a reversal of the trend. Only with a high or low without regard for range, momentum, or trend. We do not trade on a candlestick pattern alone. We use them to increase the odds of entering a trade within our trading plan. So look for candlestick patterns at support and resistance, confirmed by trend lines, bias 180, and ricochet indicators, at the top and bottom of early trend retraces, confirmation within a higher time frame. Conclusion. Candlesticks can become an invaluable tool that helps us read price action and make high probability trades in the markets. Remember that like any pattern, in trading none of these are correct all the time. You should use your knowledge of candlesticks in conjunction with other trading methods to make smart trades.